Risk management in Forex. Forex trading is an exciting and potentially lucrative venture, but it is not without its risks. The market is highly volatile and unpredictable, and traders can lose their investments in a matter of minutes. That is why it is essential to implement effective risk management strategies to minimize losses and maximize profits. In this video, we will discuss the importance of risk management in Forex and provide practical tips to help you protect your investments. Before we delve into the various risk management strategies, it is essential to understand the different risks associated with Forex trading. Here are some of the most common risks. Market risk. Market risk is the potential for losses due to adverse changes in market conditions. Forex markets are highly volatile, and prices can change rapidly and unexpectedly, resulting in significant losses. Credit risk. Credit risk is the risk of default by the counterparty, such as a broker or trading partner. It is essential to choose a reputable broker and perform due diligence to ensure they are financially stable and reliable. Liquidity risk is the risk of not being able to close a trade or exit a position due to a lack of buyers or sellers in the market. It is essential to choose liquid currency pairs and avoid illiquid markets to minimize this risk. Operational risk. Operational risk is the risk of losses due to internal or external events such as system failures, human error, or fraud. It is essential to have robust risk management policies and procedures to mitigate operational risk. Risk management strategies. Now that we have discussed the different types of Forex risks, let us look at some practical risk management strategies to help you protect your investments. 1. Set stop losses. A stop loss order is an order placed with a broker to sell a security when it reaches a specific price. It is a simple but effective way to limit losses and protect your investments. 2. Use leverage wisely. Leverage is a double-edged sword in Forex trading. It can amplify profits, it can also magnify losses. It is essential to use leverage wisely and not exceed your risk tolerance. 3. Diversify your portfolio. Diversification is a crucial risk management strategy. It involves investing in different currency pairs and other financial instruments to spread the risk. 4. Keep an eye on economic events. Economic events such as central bank announcements, GDP reports, and employment data can significantly impact currency prices. It is essential to stay informed about these events and adjust your trading strategy accordingly. 5. Use technical analysis. Technical analysis involves using charts and other technical indicators to analyze past price movements and forecast future price trends. It can be a valuable tool in identifying potential risks and opportunities. Develop a trading plan. A well thought out trading plan is essential for managing risk. It should include clear entry and exit points, position sizing, and risk management rules. Traders should avoid putting all their eggs in one basket and diversify their portfolios. Practice risk management consistently. Consistent risk management is essential for long-term success in Forex trading. Traders should stick to their trading plans, follow their risk management rules, and avoid emotional trading decisions. Monitor economic and political events. Economic and political events can have a significant impact on Forex markets. Traders should stay informed about these events and adjust their trading strategies accordingly. Diversify. Diversification involves spreading your risk across different assets, markets, and trading strategies. In conclusion, Forex trading can be a profitable venture, but it is not without its risks. Implementing effective risk management strategies is essential to protect your investments and maximize profits. By setting stop losses, using leverage wisely, diversifying your portfolio. Staying informed about economic events, and using technical analysis, you can minimize the risks and increase your chances of success.